33 million ounces of physical silver just vanished from COMEX vaults, and almost nobody is reacting. Not a rumor, not a forecast. Actual metal? Gone. At the same time, silver is being advertised to the public as having found a bottom at $77. That combination should not exist. And when physical supply is leaving at this speed, prices are not supposed to sit calmly. That disconnect is the signal, and it usually shows up right before a violent repricing. Here's the part most people are missing. This wasn't slow attrition. This wasn't a few contracts rolling off. 33 million ounces were withdrawn in a very short window, the kind of movement you normally see only during stress events. Inventory doesn't drain like that unless someone needs real metal immediately, not paper exposure, not cash settlement, but bars. And when physical silver leaves COMEX, it rarely comes back quietly. While headlines focused on price weakness, something far more important was happening underneath. Registered silver, the category actually available for delivery, absorbed the hit first. Eligible silver followed. That matters because registered metal is what backs futures contracts. When registered supply shrinks faster than open interest adjusts, the entire pricing mechanism starts leaning on faith instead of inventory. That's when paper prices stop telling the truth. This is why the $77 level is dangerous to trust. It looks stable on a chart. It feels like support. But it's being formed while physical metal is leaving the system, not entering it. In past cycles, real bottoms formed after metal flooded back into vaults, not when it was being drained. This is the opposite setup, and the market rarely resolves that quietly. If you were watching the physical side instead of the screen price, you would notice premiums refusing to fall. Retail bars and coins are never priced in a collapse. Industrial buyers didn't step away. Large off-take contracts continued clearing at levels that don't match the futures price narrative. That divergence is the tell. Futures are saying oversupply. Physical is saying scarcity. Both cannot be right for long. The reason this matters comes down to how COMEX actually works. Futures contracts are priced off expectations, leverage, and liquidity, not immediate metal demand. Physical withdrawals, on the other hand, are irreversible. Once metal leaves the vault, it cannot be rehypothecated, swapped, or used to settle delivery notices. Every ounce withdrawn tightens the system mechanically. That pressure doesn't show up instantly on price. It builds quietly, then it releases fast. What makes this withdrawal even more important is its timing. It didn't happen during a price spike. It didn't happen after a bullish headline. It happened while sentiment was weak and confidence was low. That is exactly when strong hands accumulate physical metal. They buy when price narratives are bearish, and availability is still just barely there. By the time the price confirms the move, the metal is already gone. There's another layer here that most retail investors never see. Arbitrage desks don't care about price direction. They care about spreads. When futures prices disconnect from physical premiums, arbitrage opens up. Metal gets pulled from where it's cheap on paper and shipped to where it's expensive in reality. That flow is silent, but it's relentless. 33 million ounces doesn't disappear because of fear. It disappears because someone saw guaranteed demand on the other side. This is where the global picture starts to matter. Outside the US, silver never traded as it collapsed. Asian premiums stayed firm. In some regions, they widened. That tells you the futures price decline was local, financial, and leverage-driven. Physical demand overseas did not flinch. When that happens, metal moves across borders. COMEX becomes the supply source of last resort. Every ounce that leaves COMEX reduces the margin for error. The system works only as long as confidence remains higher than delivery demand. The moment too many participants decide they want metal instead of cash, the math stops working. That's why large withdrawals are watched so closely by professionals. They're not noise, they're warnings. Now zoom out for a second. This isn't the first time silver has done this. In previous cycles, major physical drawdowns occurred weeks or months before explosive upside moves. At the time, prices looked weak. Commentators called it dead money. And suddenly, availability tightened, spreads blew out, and prices jumped faster than most investors could react. The move always looked obvious in hindsight. It never felt obvious in real time. The $77 bottom fits that exact pattern. It's being marketed as safety while the foundation underneath is being hollowed out. That's why calling it a bottom is premature. Real bottoms are marked by exhaustion of selling and stabilization of inventories. What we're seeing now is continued physical demand underneath apparent price weakness. That is not exhaustion. That is absorption. Within the first minute of seeing this data, anyone tracking inventory flows would know this story isn't about price action. It's about control of metal. If you want to stay ahead of these shifts, make sure you're subscribed. Because what happens next in the silver market doesn't come with headlines first. It shows up in the plumbing. And here's where tension really starts to build. Because COMEX withdrawals don't happen in isolation. They affect ETFs, they affect lease rates, they affect forward curves. When physical tightens, paper structures start behaving strangely. You'll see backwardation flicker, you'll see delivery notices rise relative to open interest, you'll see volatility compress right before it expands. All of those signals are already lining up quietly. Most people will only notice silver again after it moves violently. By then, the story will be framed as unexpected. But nothing about this is unexpected if you're watching the metal instead of the headlines. 33 million ounces leaving the system is not a footnote. It's a countdown. And the real question now isn't whether silver bounced at 77. It's how long the market can pretend that price still reflects reality while physical supply keeps bleeding out. Because once that illusion breaks, it doesn't unwind slowly. It snaps. To understand who is pulling the silver, you have to stop thinking like a retail trader and start thinking like a flow analyst. Large withdrawals don't come from emotion. They come from necessity. No institution removes tens of millions of ounces from a delivery system unless that metal already has a destination. That destination is rarely another futures exchange. It's fabrication, industrial use, sovereign accumulation, or long-term strategic storage. All of those share one thing in common. And once the metal leaves, it's effectively off the market. When you look at the withdrawal pattern, it wasn't scattered. It wasn't dozens of small accounts. It was concentrated. That tells you this wasn't panic buying. It was planned. Entities that plan at this scale don't chase price. They wait for dislocations. A paper-driven sell-off gives them exactly what they need. Weak prices, high liquidity, low public attention. That's when metal quietly changes hands. The next layer is arbitrage. And this is where the mechanism really exposes why 77 is not a real bottom. Futures prices in the US are still heavily influenced by leverage. Open interest can represent multiples of the physical inventory backing it. That works fine when most participants roll contracts or settle in cash. But when physical demand rises outside the futures market, arbitrage desks step in. They buy futures, stand for delivery, and remove metal. The profit isn't in price appreciation. It's in the spread between futures pricing and physical premiums elsewhere. At the same time, COMEX inventories were draining, and physical premiums in Asia and parts of Europe were not falling. In some cases, they were rising. That spread creates a mechanical incentive. Buy cheap paper silver. Convert it into real bars. Ship it where demand is firm. Repeat. As long as that spread exists, metal will continue leaving COMEX regardless of what the screen price says. This is why paper price declines during physical tightness are unstable. The lower the futures price goes while physical demand stays constant, the more attractive the arbitrage becomes. That creates a self-reinforcing loop. Price suppression increases physical outflow. Physical outflow tightens supply. Tight supply eventually forces repricing. The market can hide this for a while. It cannot hide it forever. Now look at ETFs, especially the large ones. ETF inventories tend to act as shock absorbers. When physical demand rises, ETFs often see redemptions as authorized participants pull metal to meet delivery needs elsewhere. That's exactly what tends to happen during these phases. Retail sees ETF holdings fall and assumes demand is weak. In reality, it often means the opposite. Metal is being pulled out because it's needed somewhere else urgently. This is one of the most misunderstood signals in the silver market. Falling ETF inventories, or whatnot, during stable or rising physical premiums usually indicate supply stress, not disinterest. The metal isn't being dumped, it's being reallocated. That distinction matters, and it's another reason price action alone gives a false picture. Then there's the futures curve itself. When physical tightness increases, you often see subtle changes before any headline move. Contango flattens. Nearby contracts and start behaving differently from deferred ones. Lease rates begin to rise quietly. These are plumbing signals. They don't trend on social media, but they tell you that immediate metal is becoming more valuable than promises of future delivery. Analysts watching this would not be asking, is 77 support? They'd be asking, how much metal is left before delivery risk rises? That's a very different question. Support levels matter in liquid markets with abundant supply. They matter far less when inventory is shrinking and demand is migrating off exchange. This is where historical context becomes critical. In previous silver cycles, fake bottoms formed when price stabilized briefly while physical inventories were still draining. The market would breathe. Volatility would compress. Commentators would declare the worst was over. Then, often without warning, prices would gap higher as availability tightened abruptly. Those moves didn't start with bullish news. They started with inventory stress. What makes the current setup more fragile is scale. 33 million ounces is not marginal. It represents a meaningful percentage of deliverable supply. When withdrawals of that size occur, they don't just affect availability, they affect confidence. Large commercial players begin adjusting their behavior. Margin requirements change. Risk managers tighten tolerances. Liquidity thins at exactly the wrong moment. Another factor almost nobody is discussing is industrial demand elasticity. Silver is not a purely monetary metal. It's embedded in supply chains. When prices fall sharply, industrial users don't reduce consumption. In many cases, they increase forward buying. Lower prices lock in margins. That creates a bid under the market that paper traders don't see. Those forward purchases often require real metal, not derivatives. So while speculative longs may have been shaken out, end users were quietly stepping in. That explains why physical flows never confirmed the bearish narrative. It also explains why inventories kept falling even as sentiment worsened. The metal was moving to where it would be consumed, not stored. Now consider the psychological aspect. Calling 77 a bottom permits market participants to relax. It suggests risk has passed. That's dangerous when structural stress is still building. Markets are most vulnerable when participants feel safe, but conditions are not stable. That's when positioning becomes lopsided and reactions become violent. The silence around this withdrawal is itself a signal. When truly bearish developments happen, they dominate headlines. When bullish structural shifts occur quietly, they are often ignored until price forces attention. This feels like the latter. Physical silver doesn't leave the system in this quantity during healthy, balanced markets. The next phase usually starts with small anomalies. A delivery month that clears tighter than expected. A sudden spike in nearby premiums. A brief but sharp move higher that gets dismissed as a short covering rally. These are the tremors before the break. They don't look dramatic at first. They only make sense once you see the full picture. Anyone tracking this professionally would now be watching one thing above all else: the rate of continued withdrawals. If metal keeps leaving at anything close to this pace, the math becomes unavoidable. At some point, futures positioning and physical availability collide. When that happens, the resolution is never subtle. This is why the idea of a fake bottom matters. It's not about calling a price. It's about recognizing when price is no longer doing its job as a signal. Right now, the silver price is telling a story that inventory flows are contradicting. One of those will eventually give way. Most viewers won't notice until silver is already moving fast. By then, the explanation will sound obvious. Demand surged, supply tightened, market repriced. But the real story starts here in the quiet phase, when metal is disappearing and the price is pretending nothing is wrong. Now we get to the part that separates casual observers from those who actually anticipate market moves. Once withdrawals reach this scale, silver is effectively in a pressure chamber. COMEX inventory is no longer a buffer, it's a countdown clock. Every ounce leaving increases the likelihood that futures prices will disconnect violently from reality. That disconnect is the stage where real alpha emerges, where those who understand the flows profit before headlines force the crowd to react. Watch the signals carefully. The first is the futures curve. A subtle flattening, or even backwardation in nearby months, signals that immediate metal is more valuable than promises of future delivery. This is an early warning of stress. Few retail traders notice it, but professionals track it daily. It tells them the market is trying to reconcile paper and physical supply, and it often precedes sudden spikes in volatility. Next is the delivery activity. When registered inventories are shrinking while open interest remains elevated, you'll start seeing anomalies. More delivery notices than normal, unexpected redemptions from ETFs, small but concentrated movements of metal between vaults. Each one is a microquake. Individually, they look insignificant. Collectively, they indicate the system is tightening and a repricing event is building. Another overlooked cue is lease rates. When physical silver is in demand, borrowing costs rise quietly. A small increase in lease rates can precede major price action. It signals that participants are willing to pay a premium just to access metal, confirming that the paper price is disconnected from the real-world value. These are invisible cracks that only appear to those monitoring the market closely. At the same time, retail sentiment is misleading. Many charts and analysts will declare 77 as support because the price seems to hold. But support isn't validated by belief. It's validated by available metal. And right now, available metal is being drained. Retail sees stability. Institutions see stress. That divergence is a recipe for explosive repricing once supply and demand realities collide. Consider the potential consequences if withdrawals continue. Physical scarcity will eventually force spreads to widen dramatically. Arbitrage desks will accelerate metal movement to high premium regions. Futures contracts may gap higher as those forced into delivery scramble for coverage. ETFs and other large holders will face redemption pressure. Volatility could spike beyond what most investors think is normal, and prices may overshoot both to the upside and on a relative basis versus industrial and retail premiums. History is clear. In previous cycles, when physical silver left COMEX at a similar velocity, the first visible move often surprised everyone. Prices jumped 10-20% in days, catching retail traders flat-footed. By the time mainstream commentary framed it as a rebound, smart money was already positioned for the next leg. The $77 bottom scenario resembles that exact early stage, except now the scale and speed are even larger than some prior cycles. Analysts and insiders would now be watching a small but critical set of indicators: daily withdrawal volumes, forward curve spreads, ETF redemptions, and Asian premium behavior. Each one acts as a gear in the repricing machine. Miss one, and the picture looks calm. Track them together, and the tension becomes unmistakable. Physical metal is moving faster than the market is pricing it. This also explains why FOMO is building quietly among those in the know. The largest physical buyers are often silent for months while accumulating. They don't make headlines, they don't post on social media, but the withdrawals tell the story for them. Metal is leaving, demand is persistent, and the paper price is artificially low. That's exactly the setup for a sudden squeeze. For retail investors, the lesson is not to chase price. The lesson is to understand that market perception lags physical reality. $77 may feel like a bottom, but it's not based on real availability. The actual market, the one driven by tangible silver in vaults, is signaling pressure, and pressure rarely dissipates quietly. When it releases, it moves fast, catching the uninformed on the wrong side. We are at a pivot point. Physical silver continues to move off COMEX. Futures prices remain disconnected. Global demand is firm. Arbitrage is active. ETF redemptions and lease rates are beginning to respond subtly. All the early warning signs are flashing. And the crucial point is this: the market often only catches up to reality after a violent move, when it's too late for many to reposition. So, what should viewers do? Watch the metal, not the chart. Pay attention to withdrawals, spreads, premiums, and delivery activity. Understand that $77 is not safe. It's a signal that the system is quietly under stress. Comment below if you've noticed these silent signals in your own tracking. Share this with anyone who relies solely on charts, because the real story is happening off-screen. If withdrawals continue at even a fraction of the current pace, the pressure chamber is primed. The breakout will likely overshoot, and retail traders will be left to scrambling. That's not speculation. It's history repeating. Mechanics at work and the inevitable consequence of physical tightness combined with paper market illusions. This is where the real silver story is unfolding. Not in charts, not in price predictions. In the silent, relentless movement of tens of millions of ounces of metal from vaults that few are watching. And once that reality asserts itself, the market will move faster than most expect. 33 million ounces are gone. And the system is telling anyone paying attention that 77 is a fake bottom. What happens next won't wait for commentary. It will happen in the metal, in the spreads, and in the forced adjustments of a market caught between paper and reality. Stay alert, watch the flows, and understand that the next move is already being written by those who control the metal, not the headlines.